When a bank that spent years treating silver like an inconvenience suddenly lets a 3-digit scenario sit calmly on the page, it isn't cheering for you, it's updating its risk vocabulary. In the first week of 2026, the loudest signal isn't a candle on a chart. It's a tone shift inside institutions whose job is to stay boring until the last possible moment. And the uncomfortable question is this: if price is supposed to be the truth, why is the truth now costing extra to touch? The screen is losing authority. Here is the part most people miss. Capitulation in metals doesn't start with fireworks. It starts with language, because language is how large players move without admitting they're moving. Silver doesn't need a conspiracy to get repriced. It only needs a mismatch between what the world needs and what the market can actually hand over. Paper markets are fast. Physical markets are real. Paper markets clear trades. Physical markets clear shelves. If you want the cleanest mental model, think of 2 clocks in the same room. One is digital and perfect, sync to the second. The other is mechanical and stubborn, powered by gears, friction, and metal fatigue. For years, we pretended they were the same time because the difference was small enough to ignore. Now the mechanical clock is drifting, slowly, then all at once, and your perfect clock is still insisting it's correct. This is where premiums stop being a retail annoyance and start acting like a diagnosis. A premium is not a tip you pay for convenience. A premium is the market whispering, "I don't believe your reference price." It's the distance between a promise and a thing. And when that distance widens, it is telling you something simple and brutal. The asset is being priced in 2 dimensions, on the screen and in the street. People keep asking whether silver can hit a specific number. That question is backward. The real question is whether the number you're staring at is still the number that matters. Because once the physical market begins to behave like a separate organism, the paper price turns into a weather app. Useful for a general forecast. Dangerous if you bet your life on it. The misunderstanding is structural. Futures were built to manage flows, hedging, inventory, production planning. But in a stress regime, the system becomes something else. It turns into a theater where leverage performs confidence while the exits quietly narrow. And that's the first reversal most investors can't digest. The more liquid the paper market looks, the less liquid the metal may be. A deep order book can coexist with an empty shelf. A tight spread can coexist with a long wait. A functional exchange can coexist with a growing reluctance to deliver. These aren't contradictions. They're the feature, not the bug, of a system that can settle in cash even when the narrative says it settling in metal. Now, layer on what changed in 2025 and what carried into 2026. Silver stopped being a single story. It used to live mostly in the investment imagination. Coins, bars, a hedge, an argument about inflation. That world still exists, but it's no longer the dominant gravity. Industrial demand has become the quiet tyrant of the equation because industrial buyers don't care about your thesis. They care about continuity. A stacker can postpone a purchase. A factory can't postpone a supply chain forever. A speculator can switch tickers. A manufacturer can't switch physics. Silver is one of those materials the modern world uses in a way that feels optional right up until it isn't tea. It's the kind of input that looks small on a spreadsheet and massive in a shutdown. The irony is that the more advanced the economy becomes, more electrified, more networked, more sensor dense, the more it depends on unglamorous metals that don't negotiate. That is why the premium matters. It's not emotional, it's operational. When premiums rise broadly, it often signals one of 3 things: distribution friction, inventory thinness, or a rising preference for immediate possession over future delivery. Those are not the same phenomenon, but they rhyme. And when they rhyme at the same time that big institutions soften their tone, it suggests the market is no longer debating direction, it's debating availability. Availability is the only debate that can't be arbitraged by optimism. And that brings us back to Bank of America and the 209 headline floating around it. Whether someone treats that number as prophecy, bait, or scenario analysis is almost beside the point. The point is that it exists inside the conversation at all, attached to an institution whose instinct is to downplay tail risk until it becomes front page risk. Banks don't publish numbers like that because they want drama. They publish them because their models are forced to acknowledge a range that used to be politically inconvenient. It's like watching a lighthouse dim, not because it hates ships, but because the shoreline is moving. That's why this feels like surrender. Not because a bank became your ally, but because it stopped pretending the old boundaries were sacred. And once the boundaries stop being sacred, the market starts acting differently. In a normal regime, spot is a reference and premiums are noise. In a stress regime, spot becomes a headline and premiums become the plot. The market stops asking, what is silver worth? And starts asking, what is silver right now in my hands, worth compared to everything else that is also being repriced? That's where the exploding premiums narrative gets misunderstood again. People hear it and imagine a straight line upward. But what actually happens in these moments is more unsettling. The market becomes discontinuous. Supply doesn't glide, it steps. Confidence doesn't drift, it snaps. And once discontinuity enters the room, even correct analysis starts feeling wrong because humans are built to expect smooth transitions. Systems do not owe us smoothness. Here's the core mechanism, the one that sits underneath all the noise. This is a silent re-rating of structure, where silver is being pulled out of the category of tradable price exposure and pushed into the category of strategic input and collateral. And that shift doesn't need everyone to panic. It only needs enough participants to prefer possession over claims, because the moment that preference spreads, the paper market is left doing what it does best, producing infinite representations of a finite object. You can see the shape of the trap from here. If you are short paper silver, your comfort comes from liquidity. I can always buy it back. But if the physical market tightens, liquidity becomes a mirror that lies. You can buy back paper all day and still not touch metal. The short doesn't die from mark-to-market pain first. It dies from the moment the market demands proof of substance. And that is why the most dangerous moment isn't when prices are low. It's when prices are high enough to tempt holders to sell, but not high enough to refill the physical pipeline. That middle zone is where institutions try to breathe again. It's where they attempt to turn your impatience into their inventory. They don't need everyone to sell. They only need enough. They don't need to win forever. They only need time. Time is the currency the system is always buying. Now step back and notice how clean the incentives are. A retail investor thinks in upside. An industrial buyer thinks in continuity. A bank thinks in survival. Those three motives collide in silver more violently than in most assets because silver is both money adjacent and machine critical. And collision is exactly what makes this feel like war rhetoric online, even when the actual mechanism is colder. It's a contest between claims and custody. Custody is slower, but custody is final. So if you're trying to understand what BofA surrenders really means, strip away the adrenaline and watch the behavior. Watch how quickly institutions normalize what they used to mock. Watch how quickly a hedge becomes a core allocation in the language of people who hate admitting fear. Watch how quickly a market can split into two prices without an official announcement. Because systems rarely announce their turning points, they leak them. And when they leak them, they do it through research notes, widening premiums, delivery preferences, and small phrases that seem harmless until you realize they are a confession. This isn't tea about price discovery anymore. It's about securing supply. That's the setup. The rest is pattern. The moment you accept that silver is being treated less like a trade and more like a strategic resource, you start seeing the next questions clearly. What does history do to assets when paper claims outrun physical reality? What signals appear before the public understands? And why do policymakers always arrive late, right when the system has no clean options left? In markets, the cleanest turning points don't look like turning points. They look like paperwork. In 1968, the London gold pool didn't collapse because the public suddenly discovered gold. It collapsed because a structure designed to smooth reality ran into an intake problem. Too many claims, too little metal, too much confidence priced as if it were inventory. The lesson wasn't that gold was magical. The lesson was that suppression regimes die the same way living organisms die when oxygen gets rationed. First, the extremities go numb, then the organs start compensating, and then the whole body pretends it's fine, right up until it can't. In 1980, silver didn't moon because everyone became a believer overnight. It moved because the market learned, briefly, that leverage can lift price, but only physical can finish the sentence. That episode ended messily, yet the rhyme remains. Whenever an exchange has to choose between keeping the game orderly and keeping it honest, order usually wins first. Honesty arrives later, with interest. Fast forward to the modern era, and you see the same mechanical sequence in different costumes. The nickel shock in 2022 was not about nickel's personality. It was about a paper structure meeting a physical constraint, and realizing, mid-sprint, that the finish line had been moved. That's what discontinuity looks like, not a trend, a gap in the floor. Now look at early January 2026 through that lens, and you'll notice something unnerving. The storyline isn't tea being driven by retail excitement. It is being driven by institutions quietly revising their impossible column into a plausible range. On January 5th, a major U.S. bank's metal strategist laid out a 2026 framework that treats gold as a primary hedge again, an average price around the mid-$4,500, and then points to silver as the more volatile companion, with a peak range implied by historical gold to silver ratios that stretches from roughly the mid-100s to around $300. That isn't a prophecy, it's a permission slip, the kind that tells you the model has stopped laughing. And a model stops laughing only when it has started to fear being wrong more than it fears looking dramatic. 3 small signals help you see what's changing, even if you ignore every headline. First, the exchange has been tightening the leash. Late December saw the futures complex raise margin requirements again, and the immediate effect was visible: sharp intraday air pockets, forced selling, and the kind of reset that doesn't feel like price discovery so much as a fire drill. When an exchange raises margins, it's not commenting on your thesis, it's commenting on stress. It's treating volatility like smoke and asking where the fire is. Second, the inventory math is getting less forgiving. As of January 5th, COMEX warehouse statistics put registered silver around 127 million ounces. Registered isn't the whole universe, but it is the portion most directly associated with delivery readiness. It's the metal standing closest to the door. And when the number standing closest to the door looks small relative to the size of the theater, the crowd's calm stops being comforting. It starts being suspicious. Third, retail premiums are no longer behaving like a normal convenience fee. With spot silver around the low 80s on January 6th, you can find mainstream retail pricing for newly listed 2026 Silver Eagles that works out to the low 90s per coin when bought in tubes, an 11-ish gap per ounce before you even get into smaller quantities, popular dates, or higher touch products. That spread is not an opinion. It's a measurement of friction. It's the market charging you extra for certainty. On their own, each of these signals can be explained away. Margins rise all the time. Inventory categories are nuanced. Retail products have markups. Together, they form a single sentence. The market is paying more for immediacy than it is paying for price exposure. This is the tell. Now widen the frame, because this isn't a one-country story and it's not even a one-asset story. Gold's surge in 2025 wasn't just a risk-off meme. It was a statement from central banks and large pools of capital that trust is being rationed. Silver's surge, more than doubling through 2025, didn't happen because silver became fashionable. It happened because silver sits at the crossroads of finance and industry. The crossroads are where traffic jams happen first. When a metal is both money adjacent and supply chain critical, it becomes a pressure gauge for two separate systems at the same time. Investors want it as a hedge. Industry wants it as an input. Governments want the economy electrified. Militaries want components that don't wait for sentiment to improve. Silver doesn't get to choose which master matters more. It simply gets pulled, and the global positioning is quietly shifting in a way that makes paper confidence less effective. China's broad money supply is enormous, well north of 300 trillion yuan, and still growing year over year. That doesn't mean 48 trillion was printed this week. It means liquidity, credit, and state-directed demand remain a persistent background force rather than a one-time headline event. Layer that with trade controls, export licensing, and strategic stockpiling behaviors that have been creeping into commodities broadly, and you get a world where the West's favorite tool, financial engineering, meets a rival tool, administrative power overflows. That matters because paper markets are optimized for price. State systems are optimized for allocation. When allocation starts to matter more than price, the physical premium becomes the truth serum. Watch how markets react before the public agrees. Silver doesn't need to move in a straight line to be in trouble. In fact, the most dangerous setup is when price becomes jumpy, rallies, dumps, snaps back, while the physical market stays sticky. That combination tells you the paper market is trying to clear leverage while the real market is trying to secure supply. Even the passive world is getting involved. The Bloomberg Commodity Index rebalancing window in early January is expected to force sizable futures, selling in both silver and gold, mechanical flows that have nothing to do with fundamentals and everything to do with formula weights. In a liquid market, those flows are a shrug. In a stressed market, they are a shove. The presence of that risk means you can get sudden downdrafts on the screen while the street price barely blinks. And that is how people get psychologically trapped. They see volatility and assume uncertainty, when the volatility is often a symptom of certainty colliding with leverage. So why does this keep happening? This recurring pattern where paper markets stretch, then snap? Because policy space is narrower than people admit. High debt systems don't have infinite clean choices. Raising taxes is slow and politically expensive. Cutting spending is slower and socially explosive. Growing out of the problem is ideal but rarely controllable on schedule. That leaves the option that doesn't require a vote. Repricing the unit of account over time, not with a speech, with drift. When policymakers need time, markets get inflation. When markets get inflation, hard assets become the silent language people speak when they don't trust official promises. Gold absorbs it first because it's the ancient mirror. Silver amplifies it later because it's the more fragile bridge between vault and factory. And that brings us back to the institutional tone shift. A bank doesn't need to be right about 135 or 309 US$ for the signal to matter. The signal is that those numbers are now allowed to exist inside respectable research as scenario math rather than as internet folklore. It means the range of acceptable outcomes has expanded. It means the ceiling got taller, not because anyone built a new floor, but because the old ceiling was made of paper. This is how the trap closes without a siren. A widening premium, a tightening margin, and a shrinking buffer of deliverable inventory, all while models relabel extremes as plausible. And the final pattern is always the same. The public waits for a single dramatic confirmation. The system delivers a series of small confirmations that only look dramatic in hindsight. If this is 1968, the stress shows up first as structure. If this is 1980, it shows up first as leverage. If this is 2022 nickel, it shows up first as a market operator choosing order over continuity. In 2026 silver, it's showing up as a market quietly splitting into two realities: exposure and possession. In the next segment, the only question worth dissecting is not how high can silver go, but what happens when a market built on cash settlement has to coexist with buyers who increasingly don't guarantee want cash. Because once that preference spreads, the repricing isn't a rally. It's a system admitting what it can no longer deliver. And what's happening here isn't a meme squeeze, and it isn't a clean bull market either. It's a slow-motion audit of settlement risk, an audit that used to be theoretical until the plumbing started showing its teeth. When a major bank publishes a high-end silver scenario like $309, the headline sounds sensational, but the subtext is colder. Someone is modeling what happens when paper claims and deliverable metal stop behaving like the same asset. Under the surface, this market now has two prices that only pretend to be one. The screen price is a reference. The street price is a verdict. And when those two drift apart, it is not because buyers got emotional. It's because the system is quietly rationing what it can replenish on demand. Start with the mechanics nobody likes to narrate because it's boring. Futures settle every day, physical settles when it shows up. That difference used to be a rounding error. Now it's the gap that matters most. COMEX deliverable inventory, registered metal that is actually warranted for delivery, sits around 127 million ounces as of the latest warehouse report in early January. That number is not zero, but it's also not a comfort blanket when the entire market is leaning on the assumption that delivery is always possible at the marginal price. Then add the second layer, policy by margin. When volatility rises, exchanges raise collateral requirements. That's not a conspiracy, it's how clearinghouses survive. But the effect is the same as tightening a valve. Leverage gets punished, forced selling appears, and price action looks like chaos. It also creates something more subtle. When leveraged paper gets shaken out, the remaining demand becomes more physical by default. Not because everyone suddenly became a prepper, but because the easiest exposure just got more expensive to carry. Now overlay the calendar. Between January 8th and 14th, large commodity indexes rebalance. That sounds like background noise until you understand what index money is. It is price-insensitive flow that sells because the weight changed, not because the thesis broke. Estimates floating around for the Bloomberg Commodity Index rebalance imply billions of dollars of gold and silver futures selling pressure concentrated into a short window. That doesn't kill a bull market, but it can create a sharp downdraft. Exactly the kind of downdraft that produces headlines like squeeze over, while the physical market stays firm and retail premiums refuse to relax. This is where the story gets mistold. People see a volatile chart and assume sentiment, but the more accurate read is inventory and financing. London Vault data shows silver holdings rose into late 2025, so the narrative of London is empty is sloppy. What tightened wasn't the existence of metal, it was the availability of the right metal, in the right form, at the right time, under the right terms. In tight markets, the issue is not whether silver exists on Earth. The issue is whether it can be mobilized without paying a penalty. And that penalty is what premiums are, the market charging you for certainty. A futures contract gives you exposure. A coin in your hand gives you delivery completed. When retail offers for newly minted sovereign coins print around the 90s while front-month futures hover near the low 80s, that spread isn't just dealer greed. It's a live signal that immediacy has become scarce. Now, about the most viral number in this space, the idea that banks are short billions of ounces. That claim is usually built by stacking assumptions on top of each other until the sum becomes cinematic. The actual public data is less theatrical and more useful. The CFTC over S Bank Participation Report snapshot for early December shows banks as a group net short silver futures by roughly 311 contracts, about 212 million ounces when you convert contracts to ounces. That is still a serious position in a tight market, but it is not a 4.4 billion ounce Death Star. The difference matters because analysis built on exaggerated inputs produces advice that is emotionally satisfying and strategically wrong. So why does a $309 scenario matter at all if the bank short isn't infinite? Because the path to repricing doesn't require infinite shorts. It only requires a thin layer of deliverable supply, meeting a thick layer of must-own demand at the same time. Silver is no longer just money, and it's no longer just industrial. It has become a hinge metal, pulled by investment motives when trust wobbles, and pulled by industry when electrification accelerates. Solar demand is not a theory. Defense demand is not optional. Electrification is policy, not preference. And then the US quietly changed the tone by adding silver to the updated critical minerals list. That doesn't automatically trigger tariffs or subsidies tomorrow morning, but it does one important thing. It reframes silver as strategic infrastructure, not a hobby. First order impact is market structure. Expect more violent swings, not because fundamentals are unstable, but because participation is index rebalances, margin changes, and dealer hedging all compress time. Moves that used to take months happen in sessions. The biggest risk isn't price down. The biggest risk is disorder. Cash and carry breaking, lease rates jumping, and delivery terms tightening. When that happens, paper exposure can underperform physical exposure even if both are silver, because one is a promise and the other is completion. Second order impact is the quiet tax on the real economy. Silver isn't a luxury input, it's a conductivity input. If silver's all-in cost rises, it leaks into the unit economics of panels, electronics, and certain defense applications. Companies don't go bankrupt because silver is expensive. They go bankrupt because they can't secure supply at a predictable cost. In that world, the winners are not the loudest bulls. The winners are the firms with contracts, inventory discipline, and hedging that actually matches their delivery schedule. So who wins and who loses if this regime persists? Winners, producers with real reserves and competent execution, refiners and recyclers with scalable throughput, and any balance sheet that holds metal without being forced to finance it day to day. Also winners, the entities that treat silver as procurement, not speculation, because they will pay up early to avoid paying anything later. Losers, anyone short volatility without realizing it. Unallocated holders who discover that exposure is not the same as access. Manufacturers who run lean inventory and assume spot price equals replacement cost. And yes, leverage shorts, because in a tight physical regime, time becomes the enemy. You can be right on price and still be wrong on settlement. Here's the timeline as a cycle, not a prophecy. Phase 1 is accumulation and stress testing. Q1 2026 is dominated by flow events, rebalancing, margin policy, and positioning cleanup. Volatility stays high. The market tries to shake conviction from anyone who can't hold through noise. Phase 2 is visible strain. Sometime across mid-2026, the signal won't be price. It will be terms. Watch spreads, watch delivery behavior, watch how quickly dealers restock after sell-offs. If premiums stay sticky even on dips, that's the market telling you the physical bid is not leaving. Phase 3 is structural repricing. Beyond that, the system adapts the only way it can, through higher clearing prices that ration demand, and incentivized supply, plus a faster build-out of recycling and substitution where possible. Mines don't respond quickly. Policy can respond quickly. Industry responds fastest of all when a line stops. The metaframe is simple. This isn't just a metal rally. It's a trust event expressed through a commodity that also happens to be essential. When those two forces overlap, price stops being a chart and becomes a negotiation between states, industries, and balance sheets. So the practical move isn't to chant targets. It's to watch the signals that don't lie. Registered inventories, lease rates, the spread between paper and retail, and whether dips are met with immediate physical restocking. If you want to understand this market early, follow the plumbing, not the pundits. And if you want the next signal before it becomes a headline, stay close. Not because anyone can time the top, but because in a market like this, information arrives as friction first and price second.